I was in my mid-30s, never invested in a stock or stock mutual fund. And that was after completing a master's degree in finance and starting work in the financial planning industry. One day at the office, my mentor stopped me in the hallway and said two sentences that changed everything. He said, "Harry, what are you worried about? If you invest in a diversified stock mutual fund, you'll never lose at all." That comment stopped me in my tracks. I paused. I considered what he said, and that very same morning, I wrote my first check to invest in an equity fund, and I never looked back. Diversification is a fundamental tenet of long-term investing that will benefit you. Hi, I'm Harry Starn, and welcome to another Starn Standard Practical Financial Knowledge video. In this recording, I'm going to share insights regarding portfolio diversification. Specifically, you'll learn about the benefits with diversifying the investment portfolio, the various dimensions of portfolio diversification, the benefits of expanding the traditional stock, bond, cash portfolio with alternative investments, and strategies for dealing with concentrated portfolio positions. Awareness of these concepts will help you reduce risk, improve the stability of your returns, and help to keep you invested during times of market volatility. The concept of portfolio diversification is often summarized as don't put all your eggs in one basket. Spreading out portfolio holdings offers several benefits, including an improved overall risk-return profile for the portfolio, a smoother set of returns over time, protection of capital, since no one position can pull down the entire portfolio, and greater peace of mind for the long-term investor. Smoother returns help to ensure that the investor remains in the market during times of market turbulence, rather than being driven to sell at exactly the wrong time due to emotional distress. That extends time in the market, which is critical to wealth accumulation. Let's examine 5 dimensions of diversification. The number of individual securities in the portfolio, coverage across various sectors and industries, exposure to companies with different market capitalizations, geographic dispersion, and exposure to different investment styles. The first dimension of diversification relates to the number of securities held in the portfolio. Academic research suggests that individual security risk is effectively eliminated when the portfolio holds at least 20 to 30 individual securities spread out across a range of sectors and industries. Doing that does not mean that any one security could not go to zero. However, if that happens, then the loss might be balanced by a couple of the securities doubling in value. That's the diversification effect. Realize that holding one mutual fund or one exchange-traded fund, an ETF, is very different from holding one individual stock. Mutual funds and exchange-traded funds may hold dozens to even a couple hundred securities in their portfolio. Light bulb thought number 1, think of your portfolio mix like having a balanced diet. You don't want your health to depend on eating one type of food, nor your financial future to depend on one investment. Sectors are broad economic groupings that include multiple industries, while industries are groups of companies producing the same product or offering the same type of service. Examples of sectors include communication services, consumer staples, energy, financial services, healthcare, real estate, and utilities. Examples of industries include wealth management, automotive, pharmaceuticals, software, and transportation. Historical data confirms that there's no consistently outperforming sector or industry. That's because economic conditions change, and sector and industry returns reflect the macroeconomic conditions. Diversification among various sectors smooths the overall annual portfolio return, which has a meaningful impact on future compounded return. Light bulb thought number 2. Every sector has its day. Chasing yesterday's top performing sector or industry is how to underperform over time. The market capitalization of a company is equal to the number of publicly traded shares times the market price per share. FINRA, the Financial Industry Regulatory Authority, defines a large cap company as one having a total capitalization of over $10 billion. Mid-cap companies have market capitalizations between 2 to 10 billion, while small-cap companies have market capitalizations between 2 billion and 250 million. Each of these market capitalization groups exhibit unique characteristics, including the expected risk and return statistics, cash flow stability, and growth prospects. Large cap stocks are often well-recognized companies that are in the mature stage of their company life cycle. Their cash flows are typically stable, and they generally are going to pay ongoing dividends to their shareholders. Because their growth prospects are lower, the category will have a lower expected rate of return with lower price volatility over time compared to the other capitalization groupings. Mid and small cap companies are in the earlier stages of their company life cycle. Mid cap stocks typically offer a balance of stability and growth, while small caps have high growth opportunities. Investors owning small and mid cap companies are focused on profiting from capital gains. Now, because the risk of survival is higher for mid and small caps compared to the large caps, their long-term return and their price volatility is expected to be higher than the more established firms, again, over time. Light bulb thought number 3, diversify by size, not just by sector. Geographical diversification involves spreading investments across different countries and regions, rather than just holding securities offered in your home country. Diversifying investments across the globe reduces risk exposure to a single economy, including business risk, currency risk, and political risk. The benefits of investing internationally include an improved portfolio risk-return profile, access to a wide range of opportunities, some of which are located in the developing parts of the world where they have high intrinsic growth, and the potential for higher returns. Additionally, holding domestic and international securities can again smooth the annual returns, since the best performing countries change from year to year. Light bulb thought number 4. We live in a global society. Your portfolio should do the same. Another way to diversify the portfolio is by investment style. Value investing or growth investing. Value investing is based on the principles of fundamental analysis as developed by Benjamin Graham. A value strategy focuses on identifying good companies that are underpriced and holding that security until the market recognizes the actual intrinsic value. In contrast, growth investing follows the investment approach of T. Rowe Price. This approach seeks to identify companies that achieve higher than average earnings growth rates, high return on equity, and high profit margins. Again, they're looking for companies that are reasonably priced for those higher factors. The market tends to fluctuate between these two styles over time. For several years, one of the strategies will tend to outperform, only to trail the other in subsequent years. Light bulb thought number 5. Playing a sport involves offense and defense. Maybe you can think of growth investing as the offense and value investing as the defense. Adding alternative asset classes to that traditional stock, bond, cash equivalent portfolio can provide meaningful diversification benefits. The benefits include enhanced portfolio return, which is often referred to as alpha, lower portfolio volatility, and access to some portfolio leverage. The improvement in the risk-return profile occurs because alternative assets often move very differently than the traditional securities. The concept map on this slide depicts various alternative asset categories, including commodities, currencies, real estate, venture capital, private placement debt and equity, investment vehicles using hedge fund-like strategies. A concentrated portfolio position occurs when one or a couple securities represent a large percentage of the overall portfolio. For example, an investor holds 60% of their overall portfolio in one security. Concentrated positions are common for a variety of reasons, including the person owns stock in the company where they work, and they're convinced that that company stock is just going to continue to appreciate over time into the foreseeable future. There's an emotional attachment to an inherited or a gifted security. The person doesn't want to incur a tax liability when selling the security. While each of the reasons is valid in the investor's mind, there's a potentially negative consequence associated with holding that concentrated position. The first step in correcting the situation is to realize how that position, that oversized position, puts future financial welfare in jeopardy. Once that's realized, then there are strategies for tax efficiently reducing the concentrating position. These strategies include tax loss harvesting, stretching that sale over multiple tax years, or hedging the oversized holding with put options. If there is philanthropic intent, then some of the shares could be gifted to charity. In this video, you learned about the benefits associated with diversifying the investment portfolio, the various dimensions of portfolio diversification, including the number of individual securities, the sectors and the industries, market capitalizations, geographical locations, and investment styles. The benefit of expanding the traditional stock, bond, cash equivalent portfolio to include alternative categories and strategies for dealing with concentrated portfolio positions. Well, thank you for watching this practical financial knowledge STARN standard video. I hope you found the information valuable for positioning your investment portfolio for long-term wealth accumulation and asset protection. I invite you to watch other STARN standard videos that I've posted on investment planning or other pieces of the personal financial planning puzzle. If you found the video useful, then please tap the like button and consider subscribing to the STARN Standard channel. Have a great day and hope to see you in a future video.